Because of the pandemic, 45% of millennials have had to tap into their emergency funds. And if they weren't prepared, their financial situation could have been a lot worse. So we put together a video to go over how essential it is to have a cash reserve.
Welcome to our channel. We hope you're safe and healthy during these trying times. 2020 hasn't turned out quite the way most of us hoped it would. And if there's one thing we learned about personal finance these last few months, it's the importance of having an emergency fund.
Think back to those moments last year when you debated between spending money and putting it in this fund, thinking, what kind of emergency could possibly be so big? And now, with hundreds of thousands of medical emergencies, record unemployment rates, and a delicately poised economy, think about how much your life has changed since then.
An emergency fund helps you sleep a little easier when times get tough, and is considered to be the first step in planning your financial journey. It's simply money kept aside to meet unexpected needs for cash. And we're talking true emergencies here, not a flash sale at Banana Republic, however tempting that might be.
Think of your emergency fund like a parachute. It's better to have it and not need it than to need it and not have it. It's essentially a backup plan that protects you from risk. This risk could be medical expenses, unemployment, car breakdown, or even house repairs. If your family is in a different country and you need to fly back home immediately, that would be included too.
Naturally, the next question would be, how much should you put into this fund? The general rule of thumb is 3 to 6 months worth of living expenses. When we say expenses, it refers to essential expenses like food, rent, and bills. This is because in a crisis, you likely cut down on discretionary expenses like traveling abroad or eating at fancy restaurants. So it's necessary to budget and know exactly what that number is for you.
If you have high interest debt from student or car loans, then a good strategy there might be to put away only a few $1,000s at first. Once you have that buffer, focus on paying off the debt and then continue to build out your fund to its full size.
So how do you build your emergency fund? It's extremely unlikely that any emergency will require using all your savings at once. This is why we employed a tiered approach to building our emergency funds. By doing this, you can use your most liquid assets to pay for immediate expenses and then rely on less liquid assets if the situation really gets out of hand.
Let's show you what that means. The fund is broken down into 4 tiers. The first is physical cash. If someone steals your identity or there's a blackout from a natural disaster, it's not easy to access funds from your bank. That's why it's important to have at least a few $100s in your house or apartment where it's readily available. You probably want to keep it in a fireproof or waterproof safe just to make sure that it's secure.
The second tier consists of around 1 month's worth of expenses in a checking account. This should be enough to cover any normal emergencies and allows you quick and easy access to your funds. There are times when even a few extra days to access your money could cost you, so being able to withdraw quickly from your local bank's ATM is crucial. Checking accounts offer close to 0% interest rate, so make sure you don't park multiple months worth of cash here.
The third tier consists of having 2 to 3 months worth of expenses in a high yield savings account. As we mentioned in our previous video here about passive income, they provide about 10 to 15 times the interest of a traditional savings account. For example, one that I really like is Discover Bank. They offer 1.15% interest rate, and if you open a checking account with them as well, then the transfers between the two are instantaneous. Just a note here that you're generally allowed only 6 withdrawals per month from these accounts, but the Fed currently has waived this limit during the pandemic.
The final tier consists of around 2 to 3 months worth of expenses in certificate of deposits and government bonds. We're not going to jump into too much detail about them, but they're generally considered to be safe investments that yield higher returns than the previous ones we've talked about. Unfortunately, they're also less liquid, which is why this would be the last portion of your emergency fund you tap into.
By splitting your fund across multiple tiers, you strike a good balance between having enough to cover you during a setback and sacrificing potential growth from investing your money.
Very quickly, if you like our video so far, please give it a thumbs up and hit subscribe if you haven't already. It helps the YouTube algorithm and motivates us to keep creating videos for y'all.
Okay, the amount you choose to distribute across these various options really depends on your individual risk tolerance. There's no magical one-size-fits-all number that everyone should adhere to. As we mentioned, the general rule of thumb is 6 months worth of expenses, but you can adjust this number up or down based on various factors.
For example, if you have trouble finding another job, work in a declining field, or have chronic medical problems, you probably want to adjust that number up to give you more of a cushion. On the other hand, if you have a steady job, have high credit limits, and have adequate liquid assets, you probably don't need as much of an emergency fund.
At the end of the day, the right amount really depends on your personal comfort level. You'll need to look at your individual situation to decide what's best. Just think about what helps you sleep at night. During the last recession, credit card companies and banks closed accounts and lowered limits. I sleep well knowing that my plan works even if these things happen again.
And now, in more recent times, I hope we're all able to build our emergency funds to a point where we don't constantly worry about it. Thank you all for watching. Stay safe, stay healthy, and we'll see you next time.